I know times like this, you just take it slow. I fall asleep in the pillows. She got my heart in a chokehold. And there she goes.
Assalamu alaikum. Hello everyone. This is Liquidity Club by Ahmed Shawi. Today is Sunday, the 3rd of December 2023. I'll be doing the weekly market review. So let's get started. Starting with the DXY, as you can see last week, we've attacked the sell side liquidity as I've mentioned. Since we closed below the weekly constant encroachment, I was expecting a run below the sell side liquidity, and how far below can it go? We have the constant encroachment of this premium week, and we've seen that perfectly happen last week. It was very close, however, it didn't reach to it. You can go to your chart and you can see it, that it didn't actually reach it, but it was very close from reaching it. You want to draw the constant encroachment of the discount wick here. As you can see, on the daily, going to the daily time frame, we're trading at the bearish order block here, and we're feeling some of the inefficiencies that are residing there. So I want to watch out closely the high of Friday and this fair value gap. If we have a daily closure below this fair value gap, or a daily closure above this high, this means if we get a daily closure below this fair value gap, this means that the price is going to be using it as an inverted fair value gap, treating it as resistance, and then resuming going lower, attacking the sell liquidity and the wick constant encroachment from the weekly time frame right there. However, if we take out this high, this is telling me that we're likely to reach out to this high and to work out inside this fair value gap, which also it's a weekly fair value gap, and we have a bearish order block right there. So this is what I'm going to be expecting. Why did I choose this level exactly? I'm going to be explaining everything, so I'm leaving no room for ambiguity. The constant encroachment, the mean threshold of the bearish order block here, the mean threshold of the bearish order block is this high. I know that you don't believe me. Go to your charts, plot a Fibonacci or something to measure from this high to this low, or from the bodies. You can measure the bodies also, because there is an extent when the bodies or the wicks, there's no difference between them. So you can measure the bodies or you can measure the wicks, whatever works best for you. I honestly measure both, and I want to see the relationship with how the market is treating with both of them. So you can see that the mean threshold of this bearish order block is the Friday's high. Friday went up higher, traded to the mean threshold, and then it retraced immediately. You can see how sensitive the mean threshold of a bearish and bullish order block is. So now if we close above this, if we get a daily close above this high, this is telling me that we're likely to see higher prices, a retracement to this buy side liquidity, we have the fair value gap and the bearish order block. However, if we have a daily closure below this fair value gap, which I didn't mark it, from this candle's high to this candle's low, from Friday's low to Wednesday's high, this fair value gap, if we get a daily closure below it, this is telling me that we're likely to go to see lower prices. Why this fair value gap? Because from the weekly, as I've told you earlier, you need to draw a constant encroachment line at this discount wick. You see that the discount wick reside there. So if we close below it, this means that we're likely to see lower prices, attacking the sell side liquidity and perhaps reaching to these relative equal lows. So right now I'm not being bearish primarily, I'm not being bullish primarily. I have a criteria, and if so, then it's like an equation, and if I get the first condition, the program will run itself. So think of it as a script. In order to run the script on a program, some certain variables has to be there in the code itself. And I've just shared the codes right now. If we get higher prices, if we get a daily closure above this high, the script will run to run higher prices. If we get a daily closure below this fair value gap, we'll run the script to run lower to attack the sell side liquidity. And no one knows. We actually have the variables on the table and we work with them. So I think that's gonna be pretty much it for DXY. Going to ES, here reviewing the continuous contract and reviewing the weekly time frame. As you can see, last week I mentioned that we're likely to see a run to the buy side liquidity because we have unfinished business. When we closed right there, we were closer to the buy side liquidity than we're closer to the weekly fair value gap. But right now, after we've walked inside the buy side liquidity that I've mentioned earlier, and if you go to your charts and draw a line, if you go to check what is the low of this candle, which is the high of the fair value gap, there's a small fair value gap right there. How far can price reach above this buy side liquidity, this fair value gap? And you can see how price reached to the high of the fair value gap, or the candle's low, this candle's low. And then now I'm expecting it, since it has worked inside the external range liquidity, which is this buy side liquidity, I'm expecting it to retrace, work inside the internal range liquidity, which is right there. We have a fair value gap. I drew it as on a form of lines. This candle's low, this candle's high, small inefficiency in price, small fair value gap, and we have a weekly fair value gap here that I drew out. We also have a weekly bullish breaker, just for your info. So now I'm expecting price to work inside the internal range liquidity. Going to the daily time frame, as you can see here, we've reached to a bearish order block. It has been touched, it has been visited here after it has been created shortly, and we formed highs, but it was very close from the bearish order block, but wasn't reaching there. And today, last week on Friday, we've actually attacked these highs that were trying to reach to the bearish order block but failed. So we took the buy side liquidity from here and we reached to the bearish order block right there. We also have a fair value gap, and we have swept the buy side liquidity when we formed the bearish order block. So this is to be considered a high probability bearish order block, because first we have swept the buy side liquidity right there, and then we traded lower. And while we traded lower, we have created a fair value gap. So there are certain variables that are present in this bearish order block that would be telling me that this is a high probability bearish order block, and price is gonna be very sensitive when it trades to it. And we can see that right there. Price touched it and then repelled away. Now I'm expecting, since I've mentioned earlier on the weekly, I'm expecting price to work inside the weekly fair value gap. But what if it wants to, let's say, to have higher prices? Of course, we're still bullish, but to resume and to maintain our bullish standpoint, we need to see some kind of a retracement to engineer some of the longs, to engineer some of the liquidity. Some of the sell side liquidity that is residing below the lows needs to be offset by smart money as longs, so they can offset them later on above the buy side liquidity. So a retracement here would take out these relative equal lows. We have relative equal lows here, walk inside the fair value gap, and then run up higher towards the buy side liquidity. Now this is a reclaimed bearish order block, since we reclaimed it now here, or a revisited bearish order block. If we close above the mean threshold, you go to your charts and you measure the mean threshold of this bearish order block from the high to the low, you get the midpoint or the 50% level. If we have a daily closure above that level, This is telling me that we are more likely to reach to this buy side liquidity. I think that's gonna be pretty much it for ES. Going to NQ, here reviewing the continuous contract and reviewing the weekly time frame. As you can see, price just been, let's say, indecisive. It has taken the buy side liquidity here, but it has not yet reached to this buy side liquidity that I've mentioned weeks in advance. We've attacked these buy side liquidities that I mentioned earlier, but we're yet to attack this buy side liquidity. We're currently working inside the monthly fair value gap, and we have a weekly fair value gap that price can be reaching to it. Measuring and plotting the consequent encroachment of the premium wick and the discount wick of last week is important, because it's likely going to be telling us if we get a daily closure above the consequent encroachment of the premium wick, we'd have to see a continuation to the upside, attacking this buy side liquidity and reaching to this buy side liquidity. And if you get a daily closure below the consequent encroachment of this discount wick, we're likely to see a continuation and it to work inside the weekly fair value gap, and we have a bullish order block here. So low, high, lower low, higher high. So this would be considered as a bullish order block. Price can work inside of it right there, and we have a fair value gap. This would be unicorn, and then we will resume going higher. It all depends on how we treat the consequent encroachment of the premium and discount wick. So it's important for you to note them down and mark them to see how price react to them next week. Going to the daily time frame. So you see here, if I would see this area of trading the last 2 weeks, I would consider it as indecisive. Like, it has the probability to go up as much as it has the probability to go down. And in these kinds of conditions, in these kinds of situations, environments, you would want to be away from the marketplace. And if you take notes, and if you have a good eyes to see that Michael, my mentor, has stopped trading exactly when these kinds of environment happened. So as if it is like a seasonal tendency to see sloppy price action or choppy price action after the 13th of November, or usually the second week of November. And you can see that like the second week of November, price had this run, and then we're done. We've just been in consolidation, being held in place. It's not being moving up higher. It took the buy side liquidity here, and then it went back inside the range. It took the sell side liquidity and went back inside the range. So I mentioned earlier that it will be very hard for me to pick a side based on the variables that is being set and given to me at the moment. I do require more intel from price action or from the markets to decide and determine what side I'm going to be picking. But one of the things that are going to be helping me is the consequent encroachment of the premium and discount wick. If we get a daily closure above any of these, it will be like sending me signals or telling me that we're likely to continue in that direction. I think that's going to be pretty much it for NQ. I mentioned earlier that we're entering in a period of time where it's going to be more sloppy. We might get a run during the last 2 weeks of December, but we'll be having to watch it closely. That's going to be pretty much it for NQ. Going to Dow. Here I'm viewing the continuous contract and I'm viewing the weekly time frame. As you can see, price has reached to the buy side liquidity in just 1 week. You can see that if you compare it to NQ and ES, ES was okay, it was moving to the upside, it has attacked the buy side liquidity. NQ was pretty much being held. It wasn't really moving up, it wasn't really moving down. So it's pretty much consolidation or being held in tight range. Dow, on the other hand, is just rallied up higher as if there was no tomorrow, and has attacked the buy side liquidity here and the buy side liquidity here, and we were very close from the buy side liquidity here. But Right now, after we have attacked the buy side liquidity, you must take time to reflect on your wins. You must take time to enjoy the moment, celebrate it. If you were in these positions, if you caught the move to the upside, attacking this buy side liquidity, or any of similar positions that you've took, take your time. Don't be in a rush. Don't be in a hurry to get back into the marketplace, trying to get more of the dopamine hit that you get from trading. Try to be more wise and try to reflect, celebrate, and enjoy the moments that you've actually caught the move from, let's say, from point A to point B. This is going to build more confidence in your trading, and surely it's going to limit your losses because the more you open positions in the marketplace, the more you invite losses. Nothing is guaranteed in the marketplace, and you must be extremely cautious when you're pressing the button, especially when you're trading live funds. Sure, when you're trading the challenges or you're doing your combined challenge, sure, it might not be in a big difference to you, but if you continue on these habits, you're gonna blow it when you're trading live funds. So it's highly advisable for you to be extremely cautious when you have reached to your objective. You draw liquidity on the high time frame and you were part of it. Your bias played out just as I've mentioned earlier. Weeks in advance, I've been calling this buy side liquidity and this buy side liquidity, and we've reached them this last week. So it's just time to reflect on how did you get it right, what the things that you did right, do more of them. Maybe you did something wrong, all right, you need to identify it and journal it. Do less of that. And this is what I call by journaling. You're getting better by journaling. You'll be identifying and knowing what are the things that you did right, and you'll be doing more of them. So your experience and your development as a trader will be to the good, and you also will be identifying and knowing what you did wrong or not right at the time when you're trading. Maybe you enter too early, maybe you enter too late. There are a lot of mistakes that a trader can be falling into trap, and you'll be doing less of those. And this is going to build you as a better trader. This is going to develop you as a better trader in the future. So anyway, I've just mentioned that we have attacked the buy side liquidity here. So I'm taking my time here, watching price can be running and continuing running to the buy side liquidity. I'm not reading to see price attacking or reaching to the highest targets. I don't require that. We're aiming and we have a narrative in mind. Since I was right there, I have a bias in mind. We were calling for higher prices, and we got that right there. This was my buy side liquidity objective. This was my draw liquidity, and we've seen that, and it's now met. It's in the market. If you go to your charts, wherever you are in the world, go to your charts, open Dow chart, the continuous contract, you would see that we have all reached to this buy side liquidity. So it's not something subjective, no, it's something objective. We have seen that in all the charts. It's not something that I can only view it. It's viewed to the whole world that we have attacked the buy side liquidity, and the people who are trying to short there as resistance once we reach there are now out of the marketplace since we've attacked the buy side liquidity. So now price can reach to the buy side liquidity as well as can retrace, work inside the weekly fair value gap. Either or. I'm not holding strictly a bias to attack the buy side liquidity, or I'm not strictly also attacking the buy side a strict bias or a narrative so that it will be attacking the weekly fair value gap. I'm now walking inside the intraday liquidity because after your draw liquidity objective has been met, it's better for you to work inside the intraday because after expansion, we're likely to expect consolidation, some type of consolidation. It can be as a bear flag or a bull flag, whatever you want to call it. And this can be as a trap, and price can just continue running lower. Going to the daily time frame, the same thing has been mentioned. Monday, Tuesday, Wednesday, Thursday, Friday. You can see the price just being continuously pushing up higher. I mentioned I think this one is the bullish propulsion block. I removed them because price didn't work inside of them. We have a fair value gap, price left it untapped, so it was left unfilled. Monday, Tuesday, we formed lows. Tuesday, Wednesday, Thursday, Friday. So this would be like a bullish order block, and this would be a bullish propulsion block. We have a fair value gap here. Price didn't reach to it. I would actually prefer the price just wicked inside the fair value gap and touched the bullish propulsion block, the high of the bullish propulsion block. It would send price even further than this, maybe attacking this buy side liquidity. But that's not the point of this recording. I think that's gonna be pretty much it for now. Going to Euro USD, also known as the fiber. Here I'm viewing the weekly time frame. As you can see, you would be looking and you would be saying, what are these lines here? P wick constant encroachment, D wick constant encroachment. I'm gonna be explained. So I'm trying to focus on what the move is gonna be, and the way I'm gonna be doing it is based on variables and the script, as I've mentioned earlier. So we have the discount. This is a discount wick, and this is a premium wick of last week. Above this wick, at the high, you have a buy side liquidity. Below this wick, or below this tail, the low would be sell side liquidity. We have the consequent encroachment of the discount wick, and we have the consequent encroachment of the premium wick. All of these numbers are based on your broker. I'm primarily using forex.com. You could be using them and you'll be getting the same numbers. I'm watching closely on the daily time frame. If we get a daily closure above any of those, so if you get a daily closure above the premium wick consequent encroachment, I'm going to be expecting price to run out this buy side liquidity and continue running up for this buy side liquidity. If we get a daily closure on daily time frame, it's very important for you to listen carefully to what I'm saying. If you get a daily closure below the discount wick, I'm likely to be expecting price to attack the sell side liquidity, which is this low, and work inside the fair value gap, the weekly fair value gap, and perhaps reach to the bullish order block. So this is how I'm framing it, and all depends on what the XY is doing. Going to the daily time frame, as I mentioned earlier, it all depends on what the XY is deciding to be doing. Because if we get a lower prices on the XY, and price or the XY confirms lower prices, as I've mentioned earlier here, if we get and confirm lower prices based on the consequent encroachment of the wick, if we close below the fair value gap and we confirm that we're likely to see lower prices, this means that the run on stop on Euro USD, this run on sell side liquidity would just be a sell side liquidity hunt or stop raid. This would be a fake bearish breaker. This would be a fake market structure shift to the downside. This would be all fake to trap retail. Some people might think or might see it as high, low, higher high, lower low, and they will be selling. Everyone will be selling at this fair value gap, or maybe even right there, like once the market opens, they will be selling, thinking that, oh, this is a market structure shift, the market is breaking down, oh, it's going to the zero. Some people might think like that, but you have to also keep in mind that we have a buy side liquidity here, we have the buy side liquidity here, the weak constant encroachment. They're still untapped. You need to be considering that. Also, you must look at DXY and what it's doing. As I mentioned earlier, what confirms on DXY, if DXY wants to run lower and has closed up below the fair value gap, rewind the video and watch and listen to what I've mentioned and what I've stated closely. If you close below the fair value gap on DXY, we like to see a continuation to the downside. And what does this mean if we continuation to the downside? This means that in Forex or the major markets that start with the foreign currency, such as Euro USD, this means that it is inversely correlated. So if DXY is going to be trading lower and we have a confirmation from the script that DXY is going to be continuing lower to the downside, attacking the sell side liquidity and reaching to the weak consequent encroachment, this means that Euro USD, Pound USD, any of these forex markets, we're likely to see a running higher, price running up higher, because it's just inversely correlated. These are the basics and the principles of the forex market. If the XY is running up higher, Euro USD and Pound USD will be running lower, and it will be an immediate reaction. It will not be a long-term effect, such as the relationship between DXY and the US indices, or the US index market. In the US index market, let's say DXY is running up higher, and can ES be running up higher? Yes, it can, but on the long term, it will have effect that ES will have to go lower, because it's a long-term effect. It's not an immediate reaction, and it's not an immediate effect, just like the relationship between Forex and DXY. In the relationship between the DXY and the Forex market, we see an immediate reaction and response. If DXY traded lower, Forex market is going to be trading higher immediately. There's not going to be delay, and if we see the delay, this means that there is a crack in correlation. Smart money are either distributing or accumulating positions in the given Forex market that is present at the moment. But usually and most likely that if DXY, and is in our case, if DXY wants to continue running lower, EURUSD is likely to be trading higher, attacking the buy side liquidity here and here. So it all comes down to what DXY is trying to do. We need to get the confirmations from DXY next week and try to work with that. If DXY decides that it wants to go lower, we're likely to see and view this as a stop raid hunt, or a run on stops, run on sell side liquidity to accumulate positions by smart money if they want to accumulate. And as you can see, it has traded to the daily inversion favor gap, treated it as support. So this could be also a factor that we've walked inside of it, and now we're likely to continue running up higher. It all depends on what the XY is trying to do. We have a fair value gap here. If the XY decides that it wants to run up higher, this can be used to go short. If the XY confirmed to us and it has closed below the fair value gap, this is telling us that this can be used as an inversion fair value gap in the future. Yeah, I know maybe some of them just went over your head. Rewind the video and you will get it eventually. If we see price close below the fair value gap on the XY and we confirmed lower prices, we'll be utilizing this fair value gap as an inversion fair value gap earlier. So price will be closing above it, retracing, treating the high of it as support, which sends price higher to the buy side liquidity. I would love to see price close above it, but don't take this high. Don't take the buy side liquidity. Get a retracement. This can be on a view of an immediate rebalance, and then continue running up higher to attack the buy side liquidity here, and we have the buy side liquidity here. So it all comes down, as I mentioned earlier, on what the XY is trying and deciding to do, and we'll be working with that. But it's very important to keep in mind that this can be a fake market structure shift. So don't be fooled in it. You must have an inter-market analysis where you're basically comparing and contrast the relationship between the Forex. Let's say you're trading the Forex, you must look at the XY and pretty much knowing what it's likely to be doing, because you cannot be just, if you're trading Forex, you cannot just be looking at Euro USD and you'll be done. Your analysis will be done. No, you must look at the XY. You must look at bonds market, because they're all going to give you the decision at the end that this is going to be a... Now, some people who look or trade patterns solely are going to be selling here. I'm telling you, people are going to be selling here without looking at the XY, without looking at the bond market. They're going to be selling here, trusting that this is a bearish breaker. This is a bearish breaker that ICT has taught me. This is the high, a low, higher high, lower low. This is the pattern that ICT has taught me. There has to be no way that this is going to be failing. Nope, I'm gonna be having 100% win rate, and sometimes you don't. sometimes you fail miserably because you're just following patterns. You're not trading and you're not following liquidity. You're just looking at patterns. So there's, at the end of the day, there's no difference between you and between the people who are trading the patterns that were taught in the books by the retail analysis by John Murphy, I think his name, the author name. So there's no difference between both of you. You're just trading a pattern that is developed by ICT. It was coined by ICT, and they're trading the patterns that were produced by John Murphy. So there's basically no difference between both of you. You have to look at liquidity, buy side liquidity, sell side liquidity, and inefficiencies in the marketplace, and you must have intermarket relationship and analysis. So you're not just, if you're trading the forex market, you're not just looking at the forex market. You must look at the forex. You must look on the US indices, or excuse me, yeah, you can be looking also on the US indices. You look for the DXY. You look for the pounds. You have an interrelationship with all the markets. You know what the markets are trying to do in the long term. So enough of the talking here. I went to Toronto here. That's gonna be pretty much it for Euro USD. Going to Pound USD, also known as the cable. Here I'm viewing the weekly time frame. As you can see, last week we closed above the wick consequent encroachment of this premium wick, and we also closed above the weekly inversion pivot gap. If you go to the past and if you go to the earlier weekly reviews that I mentioned, you would see it there from which candle to which candle. But nevertheless, we've closed above it. Now I'm expecting price to treat the high and the consequent encroachment of the weekly inversion pivot gap as support that sends price up higher towards this buy side liquidity right there, this high of this candle's high. So we get some kind of a retracement, manipulation here into the weekly inversion pivot gap, either the high or the wick consequent encroachment, and then distribution towards the buy side liquidity. So we can see Tuesday or Wednesday form the low of the week, and then Thursday or Friday form the high of the week. I can be wrong, but this is what I'm expecting from Pound USD. Going to the daily time frame, you can see that this is a potential bullish order block here that's forming. We have traded lower, filled this fair value gap, and now we're basically trading up higher, and we took out this down close candle's high. So this would be qualifying it as a bullish order block. Price can be treating it as a bullish order block that sends price up higher. And you can see that the bullish order block open is closely, or it's relatively approximate with the high of the weekly inversion fair value gap. So, and also, yeah, so if price wants to retrace later and utilize this bullish order block, it would be near to the weekly inversion fair value gap. So we have more influence at that level to see price repel and sends price away from it. I think that's gonna be pretty much it for the weekly market review. I have some other notes I want to mention. Is that first of all, we have NFP next week on Friday. I think it's on the 8th of December. So it is really advisable for you to finish your trading activities by Wednesday's London or Wednesday's New York. Basically, try to finish all your business on Tuesday, and on Wednesday you'll be done. Maybe you can trade the London session, but that's going to be pretty much it. So try to limit your trading to Wednesday's London. Anything later than that and until NFP, which is on Friday 8:30 New York AM session, New York time, it is all gonna be low probability. You'll see deeper retracements. You'll be seeing a longer period of consolidation, and all of that is also coupled with the seasonal tendency that we're entering a time of a year which is gonna be a low volume. Most of the people are gonna be finishing their trades early, closing their trades and just going and enjoying the weekend, enjoying their holiday. So it's really advisable for you to be really cautious when you're trading, especially because we have NFP next week. One more last thing that I want to mention, that we are likely to see the contract switch in the US indices. We're currently trading the Z or the Z contract. We're likely to convert or to transition to the next contract, which is going to be the H. For example, if we're trading the ES and we're transitioning into the new contract, it's going to be ESH 2024. So, and the same applies to NQ, Dow, which is going to be YM, as I mentioned earlier. And yeah, that's going to be it. And how the way you keep track of it, if we're transitioning or not, is through barchart.com. I'm either going to be linking the website in the description, and I'll be having a detailed view next week's review. So that's going to be pretty much it for this weekly review. I hope you found it insightful. Until I talk to you next time, be safe. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.